This is the story of how borrowing cheap money from Japan quietly fueled global booms and triggered devastating crashes when it all unraveled. In September of 2008, as the global financial system began to collapse, something strange happened. Banks were failing, stock markets were crashing, trillions of dollars were evaporating. And yet, a currency that had been ignored for decades suddenly surged. Not because Japan's economy was booming and not because investors believed in its future, but because of a trade most people had never heard of. This is the story of the yen carry trade, a trade built on cheap money, on calm markets, and on the dangerous assumption that nothing would ever go wrong. A trade so massive and so hidden that when it unwound, it sent shockwaves through every major market on Earth. For years, it quietly fueled stock market rallies, emerging market booms, and asset bubbles across the globe. Until one day, everyone rushed for the exit at the same time. And when they did, the cost wasn't just measured in money. It reshaped currencies, central banks, and the way the world thinks about risk itself. So how did a low-interest loan from Japan become one of the most powerful forces in global finance? And why does it still matter today? To understand that, we have to go back to a country that spent decades trapped in economic limbo. Japan in the late 1980s looked unstoppable. Tokyo real estate was so expensive that at one point, the land beneath the imperial palace was said to be worth more than all the real estate in California. Stocks soared, credit exploded, and confidence was absolute. Then, everything collapsed. By the early 1990s, Japan's asset bubble had burst. Banks were buried in bad loans, companies stopped investing, and consumers stopped spending. Japan entered what would later be called the lost decades. Growth stalled, inflation vanished, and deflation became a constant threat. To fight this, the Bank of Japan did something radical. It pushed interest rates down, and then even further. Eventually, Japan reached a world-first zero interest rates, and later, negative interest rates. For Japanese savers, this was devastating, but for global investors, it was an opportunity. At its core, the yen carry trade is deceptively simple. Here's how it works. 1. Borrow money in Japanese yen, because interest rates are extremely low. 2. Convert that yen into another currency. 3. Invest it in higher-yielding assets elsewhere. And 4. Pocket the difference. For example, you borrow yen at close to 0%. You convert it into US dollars. Then you buy US bonds yielding 5%. Or you could buy stocks or real estate. As long as the yen doesn't rise in value, you win. And for years, it barely moved. Japan's economy was stagnant, its inflation was non-existent, and its currency was weak, which made the yen the perfect funding currency. This wasn't a niche strategy. Hedge funds did it, banks did it, pension funds did it, corporations did it. Trillions of dollars flowed through this trade quietly. But there was a catch. Actually, there was a trap. The biggest risk in the yen carry trade isn't interest rates, it's the exchange rate. If the yen suddenly strengthens, borrowers must repay loans in a more expensive currency. Losses can be brutal and fast. And yet, for years, investors ignored this risk. Why? Because volatility was low, central banks were predictable, and markets felt safe. The longer nothing went wrong, the more confident everyone became. And that confidence fed the trade itself. More borrowing weakened the yen further. A weaker yen made the trade more profitable, which encouraged even more borrowing. It was a self-reinforcing cycle until it wasn't. When the global financial crisis hit in 2008, fear returned to markets overnight. Stocks collapsed, credit froze, and risk appetite vanished. Suddenly, investors wanted safety. They rushed to unwind risky positions, including the yen carry trade. To repay their yen loans, investors had to buy yen, all at once. The result? The yen surged violently. In a matter of weeks, It rose more than 20% against the dollar. That move alone wiped out years of carry trade profits. Hedge funds collapsed, emerging markets plunged, and global liquidity evaporated. What had seemed like a harmless background strategy turned out to be a systemic risk. The world learned a painful lesson. Cheap money can be dangerous. You might think that would be the end of it, but markets have short memories. After 2008, central banks around the world followed Japan's playbook. Zero rates, quantitative easing, and cheap money everywhere. Once again, the yen became attractive. Once again, investors borrowed. And once again, the trade quietly grew. Only this time, it wasn't just about bonds. Money flowed into U.S. stocks, emerging markets, cryptocurrencies, real estate, and tech startups. The yen carry trade became part of the invisible plumbing of global finance. Central banks watch the yen carry trade closely, but they can't control it. If Japan raises rates too fast, the yen strengthens, carry trades unwind, and global markets shake. If Japan keeps rates too low, the trade grows, risk builds, and future instability increases. It's a delicate balance, and Japan knows better than anyone how dangerous sudden currency moves can be. That's why policy changes from the Bank of Japan are watched obsessively by traders worldwide, sometimes more than U.S. inflation data. Today, the yen carry trade is still alive, but it's more complex. Algorithms execute it automatically, derivatives amplify it, and leverage magnifies both gains and losses. A sudden geopolitical shock, a surprise interest rate hike, or a global recession, any of these could trigger another unwind. And if it happens, it won't announce itself politely. It never does. The yen carry trade isn't just about Japan. It's about how modern finance works, how money flows across borders instantly, how low interest rates reshape behavior, and how stability creates instability. It reminds us that the biggest risks are often the quiet ones, the ones no one talks about, until they explode. If this video helped you better understand the yen carry trade and subsequent unwindings, consider subscribing for more economic history.